I am very excited to introduce my father, Carl Swenlin. I know that you have a lot of information to share with us.
Yeah, I wasn't planning to start with this originally, but with the yields crashing most recently and today especially, I thought it was be good to look at this. Now, this is from yesterday, updated yesterday. These are going to be lower still when this updates tonight. This is a favorite because it's just so colorful. This goes back to 1962, and I just trying to illustrate that where we are today is different. It's similar, but it's like to say history doesn't repeat, but it rhymes. Right now, we're getting another. Here we had a drop in the yields, and we're into another period where we're dropping, and according to what I've been hearing, we're headed to zero and below. Wanted to emphasize, just look how this is different. This is way different environment than we've ever seen before, and it's who knows what's going to happen. I don't, but it's going to be different than what we've experienced in the past, and I don't think it's. I think it's going to be worse than what we've seen. When, how bad or what, I can't say. But I mean, you look at this and you say this doesn't look like it's coming up with anything good. They have negative interest rates in Europe and around the world, actually. And I've been trying to figure out why people would buy a bond when they're not going to give you all your money back. Tom, do you have any idea why that happens?
I no, I have no answer for you there. That's a good question.
I mean, why not just leave your money in the bank?
Yeah, just give it to me. I mean, I'll just take that difference. That's fine.
Right.
I'll actually I'll cut it in half. I'll take half of what they were going to give.
So anyway, we're heading toward that, and doesn't look good to me. Let me move on to another one of my special charts here. Here's one of my indicators, or a set of my indicators. The ITBM and the ITVM, this is a breadth indicator. This is a volume breadth indicator. Here we have the PMO, and then down here we have the bullish percent index for the S&P 500. We're seeing negative divergences across there. One of the things, though, I looked at this earlier this week, and I thought okay, we're getting negative divergence, but we get those frequently, and in bull markets, they frequently don't really mean anything, much of anything. And now we're going into a pretty heavy-duty decline, and I was just questioning, was there any indicator that really gave us more solid warning on this? And I thought about the moving average chart. This tells us the percent of stocks above, and the percent of stocks in the S&P 500 that are above their 20, 50, and 200 exponential averages. And we had our divergences. Then I noticed this divergence happened way ahead of the market peak, the price peak. And let me just do an inspect here for you to show you how profound this is. This is that top on down to here before the price top. Notice that was 45% fewer stocks were above their 20-day EMA. I mean, that we're talking about each stock getting a vote in here, not just an indicator like the RSI, PMO for that matter. again, here we had before those recent top dropping down over 40% down of the stocks that were on above the 20-day moving average, and it dropped 40% from that. And just, I can't point in all the different directions, but if you noticed on the left side of the screen, that line that moved up and down, it'll show you the percentage from the top line that I drew. We also had the similar kind of action in the 50 EMAs. It was in 2018 top. That was down 27. Let's just say for the most recent here, down 19%. The thing is, the 20 EMA reacts faster. And that's something we kind of want to have. It takes a long time for our other indicators. I mean, they sort of follow what the market does. These are showing us what those stocks are doing, those individual stocks are doing. And you can't lose 40% of stocks that are strong and not have some kind of reaction from it. Notice back in that 2018 top, notice there wasn't any kind of a drop there. We got no warning from these indicators. And I'll tell you why. Because this was a parabolic advance. And basically, it just gets things really stretched. It goes too fast, too far. And let me get rid of here, notice that how far above the average's price was. It got really stretched above. So by the time it dropped down below the 20 and then in 50, it took, it was already well in advance. Same thing would have happened to individual stocks. They were going up in a similar manner, and by the time they finally reacted, it was too late to give us any warning. But I just think maybe it's just me, but I looked at this and I thought this is really profound. It really gives us it gives us direct feedback from the stocks within the average, and it's and the negative divergences here are really meaningful. So any comments on that?
Well, first of all, I think it makes a lot of sense. I mean, obviously, if the technicals are deteriorating under the surface of the market, if more and more stocks are starting to lose key support levels, we know that there's a lot of folks that trade the market and use technical analysis. I don't know what the estimate is. I know it in the past, I've heard 40% of the action that takes place in the market is based on some sort of technical trading. So if you start to see deterioration under the surface of the market, it certainly makes sense that could lead to deterioration in the benchmark index like the S&P or the Dow and so forth. So I would say on the surface, it makes sense. It's not going to be right every time, but nothing is right every time, right? It's a warning.
And it's to me, it's a kind of divergence that you really can't ignore. I mean, you get a divergence in the ITVM. Yeah, we get those, and they're a warning, but they're much more indirect in the way we get those indexes. Mm-hmm. It's just, to me, it's just, wow, this is going to be near the top of the stuff I look at every day.
Yeah, I definitely think that it would certainly make sense to keep an eye on something like this. I'm a big fan of divergences. I mean, I like to have confirmation. So if prices are going up, it could be confirmation in terms of how consumer discretionary is doing versus staples. It could be how technology is doing versus the S&P 500. It could be banks versus REITs. It could be all kinds of different things. But I think this is, looking for a breadth kind of a move where you're getting that technical confirmation from a lot of components. Makes sense to me. If they're not confirming as you're breaking out, it seems like that could be a warning sign. And I personally wouldn't act off of a negative divergence, but it would, I'd have question marks. I mean, I would be looking for reasons why I should ignore that signal. And it also would probably it would make me be much more cautious. The fact that, following some of these negative divergences that you're showing, because the stock market has had a history of falling significantly after that, I think if nothing else, it tells everybody, make sure you got your stops in play.
Yeah. The weakness to this is this is an equal weight, and each stock gets a vote, equal vote, whereas the index itself is cap weighted. So I don't know, the last time I looked at it, I used to track it. The S&P 500, the top 50 stocks account for 50% of the weighting in the index. It's, because they're all large cap, but the really super large caps can still carry, as you can see, while these others are dropping, you can still carry the index for a lot longer than you can stay solid, as it's.
Mm-hmm. Now I'm looking at this chart and I'm not really seeing the opposite true. I mean, when I look at the bottoms, the various bottoms over the past couple of years, I'm not seeing positive divergences. I don't know if you see any. I'm not really spotting anything that.
Right here you do.
Where is that? Where is it?
In 2016, you've got a series of higher lows than that. Can you see it there?
Yep.
Okay. Whereas there's the final low in price, and and this was a higher low. That's I haven't studied the bottoms that much. Obviously, you're going to get percentages are going to be different. Like for here, you could get a percentage change up to here, it'll be 100%. So you have to be wary of that. But when you get this low, this is just about as bad as it'll get. And so when it reaches this level, the zero line, it's time to be looking for a rebound of some kind.
Yeah. Oh, I got a question for you. Do you follow Dow theory?
I'm aware of it, but no, I don't.
All right, I'm going to pull up a chart. And so once I'm done, you feel free to take the screen back and show whatever you want to show. But I'm following. It is one thing that I think is important. I think the market can go up. The Dow can go up and set new highs without the Dow transports doing the same. But I think it's been clear throughout this bull market that when we finally do get that confirmation on the transports, it can make a big, big difference. So what I have here is a chart that shows the Dow Jones Industrials weekly throughout the bull market. So back 2009 till now, and you can see the uptrend remaining in play. And then down below is the transportation average. And what I found is that when the Dow would break out, so back in early 2012, and for those who maybe aren't familiar with the Dow theory, it simply looks at the Dow Jones Industrials and also the Dow Jones Transports. And if one does something, it looks for the other to do the same thing, whether it's a breakout or breakdown, but especially breakout. And once they both break out, that's confirmation. And so here back in 2012, you can see the Dow Jones Industrial Average broke out to a new high. But when you look down here at the transports, we had not seen that breakout yet. And it wasn't until almost a year later that the transports finally made the break. And you can see that while the transports were struggling, the Dow Jones didn't exactly fly. But once we got that confirmation on the transports, you can see the transports took off, and look at what happened to the Dow Jones. And then once again, we go through a period of consolidation, 2015, 2016. And here's that blue dotted vertical line again, showing that the Dow is moving to a new high in the summer of 2016. But you can see transports had been struggling for quite a while, and we're nowhere near a high. Well, about 6-8 months later, well, actually less than that, probably about 5 months later, you can see that the transports finally made the breakout. And of course, the Dow was breaking out as well. And then both went on another run to the upside. Well, just recently, we did this again. The Dow Jones broke out to a new high and so far has pulled back, but you can see the transports were nowhere near. And I've written a lot about this. I think that there are a couple of things that really trigger big bull market advances, and one of them is when the transports are going. And right now, they're just not going. And I'm not saying that they're not going to go. I'm just saying that that would be major confirmation, in my opinion, somewhere down the road, if we were to get the transports to break out. And I didn't know if you followed it. I don't know if you have any comments, or Aaron, if you have any comments, but it's something I'll be watching very closely in the balance of 2019 or even into 2020. If this market does put in a bottom at some point and try to go higher, I think we're going to need the transports coming back. Any comments on that?
Aren't there cases where the transports break out first ahead of the industrials, as if they're anticipating an increase in productivity or whatever?
Yeah.
Does that mean anything?
Yeah, I was just looking back. I haven't really seen that much in this bull market. I would say maybe we saw that back in October of 2010. It looks like we broke out here, and maybe it was just after that we broke out, probably not more than a week or two, but with the Dow breaking out. But as I look back throughout this bull market, I don't really see that anywhere. I see the Dow going up and then the transports finally making the breakout to confirm. But I think the Dow theory goes either way. I think it looks for one to break out and the other to confirm.
Right.
Yeah, I was looking at some of those divergences too, right at the end of those rises in the transports, like at the end of 2014 into 2015, your tops are declining, the market is still rising. That gave us some warning there. And look what we're looking at now, two tops that are lower, actually the last couple of tops. And that certainly, I would say, is a negative divergence.
Yeah, I completely agree. I mean, this has been, if there were two things that have bothered me about the market, and I'm on record, I've been very bullish, and I actually still am. I still believe we're in a secular bull market, but I'm not going to ignore the warning signs. And when, we start seeing the VIX up in the 20s, I'm going to have my stops in play. I'm not going to, argue with the market until the market decides it's time to settle back down again. But the two areas that have really bothered me about this whole move, and I think two reasons why the stock market has struggled to really build on its pushed all-time highs, is number one, the transports, which are obviously a huge part of the stock market. I mean, if we're moving to all-time highs, we should have a pretty good economy in play, and transport should do well in that kind of an environment. We're not getting that confirmation yet. And the other thing for me is small caps. I don't know how closely you follow small caps, Carl, but we've really struggled with the Russell 2000, not throughout the entire bull market, but again, with the all-time highs that we just saw in the S&P 500 and in the Dow and in the NASDAQ, you've got lower highs on the Russell 2000. So small caps aren't participating, and that's a lot of companies out there not really doing what the S&P 500 was doing. You follow the small caps?
Yes, I do. I keep an eye on them because usually they're going to lead when a new rally starts, and a bull market, and then they'll lag near the top. And they've been lagging for a long time.
Mm-hmm. Yeah, and kind of like the transports, you can see the Russell 2000 finally made that breakout in 2013, and when they did, we had a really nice run, not in just the Russell 2000, but the overall market. But when this group tends to struggle along with transports, when the transports struggle, that tends to be when the market really has its moments to the downside. And we saw it 2015, 2016. Once we broke out in the latter part of 2016, we had an awesome 2017 into the early part of 2018. But now here we are again, transport struggling, small cap struggling, and eventually leading to the overall market struggling. I don't know. What about you, Aaron? I mean, as far as the small caps go, do you see that
Absolutely.
problem as well?
Absolutely. We've been looking at that on the DecisionPoint show pretty much every week on Fridays, and just making a comparison of not only the small caps, but also some of the others, the mid caps and other areas, and noting the fact that they haven't even been really remotely challenging their all-time highs. And that's a problem most definitely. And, we actually do have a chart pack too. One of our chart lists is all S&P 600, all of our indicators just for the S&P 600. So we keep an eye on that too on Fridays if there's something interesting to talk about.
And then, we just had the GDP come out, and the reason that the GDP was still okay, a big part of it was the fact that their consumer spending was still there. But another factor that I think is contributing to some of the market weakness is that when we look at consumer discretionary versus consumer staples, we're not getting that confirmation on a breakout either. So as we've moved to all-time highs, I mean, if you look throughout the bull market, this ratio tends to go up. We'll go through periods, when the market was struggling back in 2015, 2016, that's when this ratio was just kind of going sideways with no real direction. When we broke out in 2017, we broke out on the transports, we broke out on small caps, we broke out on this ratio. Lots of confirmation for the bull market to the upside. But right now, transports aren't confirming, small caps aren't confirming. And while I'm not overly bearish what's going on here because we had such a big move on this relative ratio, I think it's okay to consolidate for a while. But as long as this consolidation takes place here, I think that's another thing that's contributing to the market struggling here, because anytime this ratio is starting to roll over, it's telling us that the more defensive consumer staples names are outperforming. And that's another thing that's not good for a bull market. So this would be another ratio or another chart that I would certainly be keeping an eye on as well.
Let me take it back.
Sure.
And I'm not as fast as you, Tom.
That's fine.
There we go. I have, I want to show the chart that we, I'm not sure I have it in this group, but no, I don't have that one here. But I know where I'll find it.
Is it small cap related or consumer
No,
spending?
it's one of the charts I have in my weekly commentary. Here we go, broad market indexes. And it's not formatted for this page, but it still gives you the idea. I keep track of the equal weight RSP for the SP 500, but also mid cap, small cap, and you can see how they're struggling. And today they're not doing so bad, are they?
Today?
The 600.
Let's see. I've got.
It's down a little, but
yeah, on a relative basis, not doing too bad today.
And of course, the Dow, NASDAQ, and the composite index. But yeah, we watch those on a regular basis, and that chart of the equal weight index is one of the ways I keep track of what the smaller cap stocks within the large cap index are doing.
Mm-hmm. Well, I know the small caps. I normally don't look at the S&P small cap 600. I usually use the Russell 2000, but they're similar. And I know that the Russell 2000 relative to the S&P 500 is sitting near a 15-year low, relative low. So this kind of weakness, small cap weakness, has been somewhat unprecedented. And if the market's going to go higher, I think the small caps have to lead to the upside.
Right. Yeah, I totally agree with that. Here's another chart that I look at on a daily basis. This, except for the price index and the VIX, this doesn't update until the end of the day. But this is where we keep track of climactic activities in the short term. we use new highs and new lows, and we can only use that when the market is making new highs and new lows. But here you can see, while the market was making new highs, the number of individual new highs just completely faded.
Mm-hmm.
And then on this decline, we had all this climactic movement. Here we have the VIX. We use a reverse scale, reverse scale log chart, and that gives us an idea of overbought and oversold readings. It's getting definitely in the oversold area. Don't know if it's done yet. I was looking for something like this when this thing started, but now I think that maybe we'll make it more like this. Sorry, I don't know how that works. Anyway.
Hey, that's just a live show. That's what we get with a live show.
Right. So anyway, I'm thinking maybe we're into something like this. It's going to be more protracted. Even this was, what was that? I forget what was the percentage on that decline?
It was about 20%. I mean, it was close.
Yeah, okay, it was. So yeah, I was counting that as a cyclical bear market.
Mm-hmm. Yeah, I do the same. I think of this. Some are saying that's not, but I did think that was a cyclical bear, and that's typical of a cyclical bear to not last long. It's not like the secular bears like we saw 2000 to 2002, 2007 to 2009. And it's not unusual. What would be unusual, though, is to have two within about 9 months of each other. So that would be something that would be a little odd if we were to drop 20% or more from the recent high on the S&P.
Here's another chart that we have at the DecisionPoint area. PMO analysis chart. Basically, for the SP 500 stocks, we track percent above zero. That's the longest term chart. And then crossover buy signals. This is when the PMO moves above its signal line. And then percent of PMO rising. And this is interesting. We can see similar to that moving average chart that I started out with. We're getting these divergences ahead of the price top. So that's something I hadn't noticed before, and take another look at. And then this is a chart that I started. This one is a percent of IT trend model buy signals. That means that the 20 EMA is above the 50 EMA on the individual stocks within the index. So up here we had over 80%. Over here we had high 70s. I don't consider that a huge imperative type of divergence, but it was a divergence. This one is, I'm calling it the Golden Cross Percent Index, and I bet you can figure out what that is just from the name. That's the percent of stocks where the 50 moving average is above the 200 moving average. And it moves a lot more slowly, but here again, we've had, it's just like a little above 75. Here was not quite as high, but these kind of indicators, they follow the philosophy that things get as good as they're going to get, and then they get worse and worse till they're as bad as they're going to get, and then repeat the cycle. Right now we're up. We've gotten to the area where probably as good as it's going to get for a while.
All right. It's always a pleasure to have you on the show, Carl. I know our audience really enjoys all of your great insight and through years of experience. And just want to thank you again for stopping by today.
Thank you, and happy to be here.